Good morning, everybody, and welcome to our latest webinar, Navigating Inheritance Tax with Clive. We will be taking questions as usual at the end, so if you'd like to pop them in the Q&A box and we will get through them, hopefully. If we don't panic, I will download them and we will answer them and we will attach them to the bottom of the email when we send out the recording and slides. Thanks, everybody, and over to you, Clive.
Thanks, Sarah. Good morning, everyone. Welcome to today's webinar on inheritance tax. Slight issue with the slides here. Just hang on a sec. Okay, back on track. Sorry about that, folks. This is me, Clive. Deal with all aspects of tax, a lot of private client stuff of late. So it's still got an issue with my slides. Right, I'm back in the room. I'm not back in the room. I don't know what's happening here. Hang on a sec.
I'll press your slides and then you present. Don't panic.
Apologies again, folks. So inheritance tax is obviously a very large subject. What we're going to look at today, the new rules for IHT now based on residency, the residence nil rate band, potentially exempt transfers, gifts out of income or normal expenditure out of income, the upcoming changes to business relief, APR, and the old favourite, family investment companies. So if we look at IHT and long-term residency, now a UK resident, if you've been resident for 10 out of the last 20 years, you'd be liable for IHT. So for somebody leaving the UK in 2025, 26, that year won't count. So the first year would be 26, 27. Therefore, won't be non-resident for IHT until 2036, 37, which is quite a long tail. So looking at it in scheduler form there, you can see it's not until 2037 that you've gone past the 10 years of non-residency, or look at it the other way. 19 out of 20 years for the first year, and it's only in 2037 that you've managed to get out of the 10 from 20. So even if you do achieve the non-resident status for IHT, you'll still be liable to pay IHT on UK citus assets. UK shares, for example, you could consider using an offshore bond wrapper or an offshore structure. UK bank accounts, of course. UK property, an offshore structure for that won't work because of rules introduced in 2017. It used to be very popular for non-domiciled individuals to have offshore trusts and offshore companies that held UK properties, which, because the shares in the companies were offshore, they weren't a UK asset. That all changed in 2017 for residential property. Non-residents still, of course, have the 325 nil rate band, and they may also still qualify for the 175 residents nil rate band. So where a client is intending to be long-term non-resident for IHT purposes, it's probably sensible to undertake planning anyway, just in case non-residency isn't achieved for whatever reason. For example, if a client died in year 9 of non-residency, it would still be chargeable to UK IHT on worldwide assets. So if you hadn't done any planning, you wouldn't have achieved anything. But if you'd still carried on as normal, so to speak, and made gifts in years 1 and 2, they would be outside the estate for IHT. The usual 7-year rules would, of course, apply. The residence nil rate band, maximum of 175,000 per individual. No residence nil rate band at all if the estate is above 2.35 million. Above 2 million, the relief is, of course, tapered by £1 for every £2 over the 2 million. And note that these limits are before any relief such as business relief or agricultural property relief. Husband and wife may each individually have estates less than 2 million, but on second death, all the residence nil rate band can be lost. So consider owning the main residence, for example, as tenants in common and leaving property to children on first death. There are extremely complex downsizing rules. If you're going to take advantage of those, keep detailed records to trace flow of funds. Moving on to potentially exempt transfers. As many of you will know, gifts exempt provided the donor survives for 7 years. Taper relief can apply for gifts between 3 and 7 years, but that only applies once the pets exceed the available IHT nil rate band of 325,000. That could, of course, be 650,000 if you'd inherited your spouse's nil rate band. And with taper relief, the effective IHT rates on the gift are, as you can see, 3 to 4 years, 32%, reducing at 8% per year to 8% between 6 and 7 years. There are, of course, the gifts with reservation of benefit rules to ensure that when you do make a gift, it is an absolute gift and that you can't retain any benefit from it. Commonly, this would be, for example, giving away a property, a holiday home here, and continuing to use it year after year. So to avoid the gift with reservation of benefit rules, you'd have to pay a market rent for using the property. If death occurs within 7 years, it's the recipient of the gift that's liable to pay any IHT that is due. Sometimes life policies are used, decreasing term assurance can be used to cover any potential IHT. And there's a planning point here which ties into the residence nil rate band. I've called it deathbed planning here, which might be slightly dramatic. But let's look at an example. Ralph is a widower and has a potential residence nil rate band available of £350,000, but he has an estate valued at 3 million. If he does nothing, he obviously won't get any residence nil rate band because he's well over the limit. However, if he gives away £1 million to his children as pets, it doesn't matter if he survives 7 years. The value of his estate for the purposes of the residence nil rate band is 2 million. So here, even if the pets fail, he doesn't survive the 7 years, the IHT savings is 140,000. Moving on to gifts out of income. Rumoured that this might be a target in the upcoming budget. Gifts must be made as part of the normal expenditure of the donor. HMRC's interpretation is that gifts should form part of a regular pattern of payments, Christmas and birthday gifts, family holidays, school fees, etc. The donor, of course, must retain sufficient income to maintain their standard of living, and gifts must be made out of income if the donor has to resort to dipping into their capital to fund their standard of living, then it won't count as a gift out of income. It's also important to note that income from earlier years doesn't retain its character as income indefinitely. HMRC's view is that income becomes capital after 2 years. So if you had surplus income of 20,000 in 1 year, 20,000 another year, and in year 3 decide that you want to give away some money, then the first year won't count. You can only use the 20,000 from the previous year and the 20,000 from the current year. So it's essential to maintain detailed records. Obviously, when the inheritance tax return is made on death and there's been a claim for gifts out of income, it's usual for HMRC to ask you to basically prove what's been paid out and how it's a gift out of income. Of course, now pension funds are liable to IHT from April 2027. So IHT planning sort of turned on its head a bit. Used to be the last thing that you accessed was your pension fund because it was outside IHT. Now possibly it might be the first thing that you look at drawing down on. What we're seeing is that people are considering drawing down pensions funds and distributing the after-tax amounts as gifts out of income. Keep it within the basic rate bands. Obviously, the effective tax rate then is at 20% as opposed to 40% IHT. So some saving achieved there. Next, we'll look at business relief. Obviously, as most of you will be aware, not all of you, major changes to business relief announced in October 2024 budget, effective from 6th of April 2026. From that date, there's going to be a 1 million individual limit on BR and APR combined, actually, which refreshes every 7 years, and the excess over 1 million eligible for 50% relief. So consider planning now, or certainly before 6th of April 2026, when we've still got 100% relief available. And also, when the new rules do come into play, consider using the 1 million limit every 7 years where that's possible. The application of business relief to trusts can be an important planning point here. Existing trusts holding assets or shares, more usually, that will qualify for business relief. They may have been put into trust a few years ago, 100% business relief claimed as part of an inheritance tax exercise. Sorry about that. Trusts that were established before October 2024 will only fall under the new rules on the first 10-year charge date. So trust where the 10-year charge date is 2028, the old rules still apply from 6th of April 26 to the 10-year charge date. So consider distributing business relief qualifying assets before the 10-year anniversary. So you're getting the 100% business relief. Obviously no IHT will be payable. For trusts that straddle the 10-year charge date, as I understand it, the 10-year period will be split into pre and post 30th of October periods to apply the 10-year charge. Moving on, still on business relief, but accepted assets. I thought it'd be worth just going through this in a little detail because it can be misunderstood. Business relief can apply to investment properties held by trading companies, which some people don't really appreciate. So because of that, it's important to consider structuring of a business where there's a mixture of trading and the surplus cash, let's invest in property. It's important to consider how you do that, maybe from a business relief angle, but also a commercial perspective as well. So fundamentally, remember that business relief applies to companies that are not wholly or mainly investment companies. The legislation is phrased sort of negatively, if you like, to say that it's only if it's an investment company that business relief doesn't apply. And it can lead to some unexpected results, which I'll demonstrate on this next slide. Let's take company A, a holding company, and it has two subsidiaries. A subsidiary company B, an engineering company, trading company, valued at 7 million. And it's got another subsidiary C, a property rental company, valued at 3 million. Overall, clearly, it's a trading group. The value of the engineering company far outweighs the property rental company. But relief is restricted. Business relief is restricted by the value of subco C. So in this case, business relief would only be available on 7 million. Compare this to Company D. Company D doesn't have any subsidiaries. Surprisingly and coincidentally, it's an engineering company valued at 7 million. And it also has a property rental business valued at 3 million. In this case, there wouldn't be any restriction to business relief. Somewhat bizarre, but those are the rules, I'm afraid. So it's important to consider the structuring, particularly with regards to business relief, when you have a client company that says, right, we want to invest in property or whatever it is, whether you do that as a standalone company, part of the main business. I mean, the downside, obviously, if company D here, they want to sell the engineering business separately. Obviously, wants to retain the property rental business, you'd have to do some sort of demerger to separate it out. So there are obviously, as always with tax, there are a lot of things to consider. Moving on to family investment companies, still very popular. We do a lot of work with family investment companies. Reasons being, most clients obviously familiar with a limited company setup. They understand share capital, directors, etc. And there's a certain mystique, shall we say, about trusts and the complexities that can arise with trusts. Companies can be unlimited for privacy. Unlimited companies don't have to file accounts at Companies House. And the company may be more flexible than a trust as circumstances change, family circumstances change, children, grandchildren, divorces, etc. Lots of things. And it may be easier to manage administratively a a company, our family investment company, particularly paying dividends, for example, through a trust. The trust would have to pay tax, there's tax credits attaching to it, etc. So it's somewhat cleaner than just using a traditional family trust. Why we use them, of course, is that the main object for IHT planning is to ensure that the future growth in value of the FIC falls outside the parents' estates. And we achieve that through the issue of growth shares. And depending on the circumstances, size of the family, how many children, grandchildren, etc., you may have several classes of growth shares. I think I've gone down, I've seen up to L, I think is about as far as I've seen them go. So on growth shares, sort of in professional press at the minute, do the growth shares have value on issue? The answer is depends. What's normal is to put in a hurdle rate attaching to the growth shares, so they only participate in value over a set hurdle. Just to look at an example, if a company has 5 million in property, which has been funded by 5 million loan from the parents via the director's loan account, obviously the balance sheet shows nil. But without a hurdle rate, you'd have to say that there must be some value attaching to the growth shares. Excuse me. Hopefully the properties will grow in value, rental income will be received, etc. So it's important to put in a realistic hurdle. In this example, and it's entirely dependent on what's been invested in. Assuming it's residential property, depending on the age of the parents, etc. We might say HMRC will agree a hurdle of 1 million means that there's little value in the growth shares. What we do quite a lot is to use trusts to hold growth shares. If the growth shares have nominal value, little impact on the availability of the IHT nil rate band when gifted. Obviously, you don't have to use a trust. Growth shares can be gifted outright to adult children. Alternatively, consider gifts into trust and consider using multiple trusts, which is the RISAFE principle. I've covered this before in previous webinars, but just to go through it again. The RISAFE principle relates to RISAFE trustee company versus Inland Revenue Commissioners, way back in 2003, where a series of trusts were created on consecutive days. The principle being that by establishing a series of smaller trusts rather than just one trust, you can reduce the impact of the 10-yearly periodic charge, the 10-year charge, and exit charges by benefiting from a nil rate band for each individual trust. The Inland Revenue, now of course HMRC contended that these were associated operations, but fortunately the judgment went against them. You would have thought that setting up trusts on consecutive days would fall. We now have GAR, General Anti-Abuse Rule, and you'd have thought that such a setup would fall squarely within GAR. Well, here's an extract from the HMRC GAR guidance, which was 11th of September 2020, 5 years ago now. Do the arrangements in RISAFE accord with established practice, and has HMRC indicated its acceptance of this practice? The practice was litigated in the case we've just talked about. HMRC lost the case and have chosen not to change the legislation. So having done that, must be taken to have accepted the practice. So practically speaking, what can RiSafe achieve? It obviously depends on how many trusts are used and the value of the assets at the start. Basically, each trust will more or less have its own 325 exemption. If the gross shares are only worth £100, you'd reduce the 325 by £100 each time. So roughly speaking, the potential saving for each trust at the 10-year charge date is 325,000 at 6%, is nearly getting on for 20,000. So using 10 trusts, which is the maximum I've seen actually, would save nearly 195,000 in IHT. Obviously, that's going to be a pretty significant family investment company to have that much value, but potentially that is what can be achieved. Other planning that you can do for family investment companies, consider assigning part or all of their loan accounts over time. Parents still control the company, so are in control of when the assigned loans are repaid. As you'd expect, any assignment is a pet, and the usual 7-year rule applies. Where we've got gross shares in a trust and they're receiving dividends, excuse me, accumulate income within the trust whilst the children, grandchildren are minors, and distribute out when they're over 18. Commonly used to pay school university fees, and of course when the dividends are received by the trust it will have paid tax, but when the distributions are made, a tax credit attaches to the distribution, which can be reclaimed by the beneficiary if they've got no other income. And I think that just about covers it. So thank you for listening. Apologies for the gremlins at the start. Me and technology don't go hand in hand too often. And if you've got any simple questions, I'll be able to answer them. Over back to you, Sarah.
Thanks so much, Clive. Yeah, we've got a couple of questions that have come in. One of them is, I'm considering transferring my 2 remaining properties into joint tenancy with my partner and son to take them out of IHT. I'm confused about what the IHT rules are now for joint tenancy. My understanding used to be that if one joint tenant died, the other tenant automatically gained full ownership. Also, that this was outside their estate and IHT. Now I read that IHT may be due. Can you clarify, please?
Might have to go offline on this, but
Yep, no problem.
very briefly, you're saying joint tenancy, but there's a difference between joint tenancy and tenants in common. Tenants in common is a separate asset. Joint tenancy is where it automatically goes to the surviving spouse. So it can depend, but I'll happily answer that in more detail.
Yeah, no problem. No problem. The next question, under the old non-dom rules, a non-dom spouse was only entitled to 325,000 exemption.
Yeah.
What is the situation long-term non-resident spouse scenario?
Well, that will still apply to if the non-domiciled spouse would still have the 325 exemption towards UK assets, if that's what you mean.
Okay.
But
Okay.
they
We'll
would.
we'll clarify that as well with that question. Probably got time for another couple of questions. Can you get HMRC to agree growth share valuations?
Not in advance. You can do a post-transaction valuation check, which in our experience take months to come back, but you could do that post-transaction and enter into an argument with HMRC over what the value is. We've done it a couple of times, but they're not the quickest.
Okay, and then one more question. Do you think the gifts out of income will be abolished?
Uh, Somebody's been reading the press. Yeah, it's been talked about because it's an immediate exemption from IHT and not there's no 7 year sort of rule. Um, but if you think about it, if it is abolished, it means that every family holiday, etc., is effectively a pet. Every little bit of expenditure here and there. So I think it would be difficult to abolish it. Not impossible, obviously, but they might cap it and say that the maximum amount you can claim per year under gifts out of income is X amount, similar to the 3,000 uh, annual exemption that we have.
Perfect. If you just wouldn't mind moving to the next slide, Clive, with the next webinar on.
I haven't got it.
Oh, okay. Well, we thank you very much. I hope you all found that as fun and informative as I did. And we are having our next webinar in November. We will send all the details when we send out the recordings to you all. And follow us on Eventbrite, and and we'll hope to see you all for the next. It's R&D. We are looking at this at the next one. But yes, thank you very much, Clive, and thank you everybody for joining.
Thanks, everybody.